Hello class and welcome to the first video in Unit 3. We are going to start off talking in Chapter 17 about retirement benefits. So when we start talking about retirement benefits, there are two major types of plans out there that we have to worry about for accounting purposes. There are defined contribution plans and defined benefit plans. As of today, most of the retirement plans you're going to see are the defined contribution plans. Those are plans like your 401k, or as I have working for a nonprofit school, a 401b. And a defined contribution is where it is defined each period how much the employer is going to pay in and how much the employee is going to pay in. For example, a typical 401k, you might put in 4 to 6% of your paycheck each week, and then your employer might match 2 to 4% of that. The accounting for that is really simple. We're not going to go through any problems on it because you already know how to do it. It is just that amount that the employee and the employer contribute to that amount is just included in the compensation expense paid out to the employee. So there is really no specific accounting for it, because then after the time goes on, that goes into a fund that is controlled by the employee on how they are going to invest it. And if you remember back, we talked about the term vesting. Usually after you're vested after so many years, all the money you put in that you put in yourself is always yours. Whatever the company match, usually you have to work a certain amount of time, then you become vested, and then you're entitled to receive that money whenever you retire or you quit that job or close out that 401k. But as I said, for our purposes, know what a defined contribution plan is, and know that there's really no special accounting for it. One we're really going to be concerned about is a defined contribution plan. A defined contribution plan is when you start working for a company and then they say, work for us for 20, 30 years, and then when you retire, we are going to give you this. Maybe we're going to give you $40,000 a year or $50,000 a year, or, 3/4 of your salary for the rest of your life every year. Okay, those are defined contribution plans. Those are not so common anymore. Go back into maybe 1950s, 1960s, those were really popular plans. It really tried to draw people into a company where somebody wanted to get a job and they wanted to work for life. And this was a great benefit to them. But over as time has passed, they've become less popular, basically because they're hard to account for. The governmental regulations that have been put on these things as time has passed have become more stringent, and the reporting requirements and all that, because they do create a huge liability. And if companies aren't saving properly for all these benefits they've promised to pay out, it becomes a problem. So you do see this occasionally. It's rare in private businesses, but where this is most common is in the public sector, state and county, local governments, stuff like that. Most of the time they have some kind of defined benefit contribution plan. So when you hear about the state of Illinois' pension plan being in trouble, it is a defined benefit plan. So all these people are entitled to these benefits that they were promised, and the state actually has done a great job of saving the money back and investing it properly to get what they want in order to cover all of that. Okay, so that's what we're going to do. We're going to talk about defined benefit plans and how to account for it. And I have a chart up on the board. I'm going to move the camera a little bit closer here in just a second. And I think the best way to go through all this stuff is by just looking at the worksheet and stuff that you're going to have to work out. And I'll explain it as we go through it, what all these things mean and how they all kind of fit together and how we'll do the accounting with it. But the first thing we need to talk about, we're talking about PBO. It is a projected benefit obligation. In your book, I really want you to look at page 983, where it talks about the different types of benefits and the obligations and stuff like this, because these are terms you might hear throughout your working life and stuff like that. So first you have the vested benefit obligation. Okay, that is defined as the present value of vested benefits at the present pay level. So those are all the people that are currently vested that have worked the time period that are required to receive the defined benefit plan at their current pay levels and at its present value. Okay. The next step up for that is called the accumulated benefit obligation. That is the present value of the vested and non-vested. So all the people that you had these promises out to that haven't met the requirements yet, you're going to assume that they're going to meet those requirements. and that you're going to have to pay them out. And when you add those with the people that have already met the requirements, that is termed your accumulated benefit obligation. And that is also done at present pay levels. Okay, so what they're currently making is not adjusted for inflation or what possible future earnings could be. But the one that we account for is called the projected benefit obligation. It is the present value of additional benefits related to projected pay increases. So this is vested and non-vested employees at what they make now, plus estimated at the future current pay levels. At the future pay levels, I shouldn't say current in there. But so their current levels plus their future levels are going to be taken into account. These are all very highly technical numbers to come by and very hard to calculate. They are done by people called actuaries, which are the ones everybody thinks accountants are great at math. But if you want to know a great mathematician, go talk to an actuary. Those people really know what's going on there. Okay, so they will give you the projected benefit obligation. Okay, so that number, they're going to base it off employees. There's much of stuff that goes into it. What they're currently making, what the benefit offered is, what the expected rate of return is, what the implicit return or the discount rate that the employee is expecting to get off of what if they could have got this benefit today, stuff like that. How long do the employees expect to live? Many, many, many different factors that go into it. Just remember the actuaries do that and they'll give us our numbers for the projected benefit obligation. Kind of know what the other two are, but they do not come into our calculations. Okay, so now I'm going to move my computer a little bit closer to the screen and hopefully you'll be able to see what I have written up there, and I'm going to move up to the board. My back has still been killing me. I apologize for this being a few days late. For the past couple of days, I haven't even been able to sit comfortably, let alone move around and do anything. So today I'm feeling a little bit better. I'm going to be able to get up to the board and we're going to work through a problem as I explain what these things are. So you want to make sure that you have the handout either pulled up in Word off to the side of this lecture or printed out to work through, and we'll work through that problem together. So once you make sure you have that ready while I get my computer set up to start working through this problem. Okay, so what we have here is a defined benefit pension plan worksheet. Okay, so across the top, we have all the things that are going to go into our journal entries. Okay, so these are the worksheets you're going to have to make out when you're going through your homework problems, get your answers and stuff like this. We have pension expense, cash, PSC stands for prior service cost, and then it's dash OCI. Over here we have a GL, that is a gain loss, also dash OCI. Remember back from previous chapters about equity, OCI is an equity account. So we're going to have some gains and losses and some amortization and some stuff I'm going to explain here in a minute. Okay, and go there. And then finally you have your pension liability or your pension asset. I have a line drawn right here because these two over here, the PBO is your projected benefit obligation. That is what I was just talking about that your actuaries will figure out. And then PA is your plan assets. Okay. Plan assets is how much you have to pay out for your projected benefit obligation. How much does the company have saved back already to cover that obligation? The difference between those two is either a pension liability or a pension asset. Okay. So all of these accounts, well, are going to be affected by something. All of the things that could affect them are listed over here down the side. Most of these you're going to have all the time. Some of them you will not have. Okay, some of them are rare, but I have them all listed out here. Okay, so you can see an example of each one of them. start over here, service cost. Service cost is what employees have earned, okay, when they have become vested into the company. After they've got their time in and stuff, that's what the actuary is going to tell you. For this period, this many people worked and did this and this and this, and this is the service cost for the period, okay? Service costs are always going to affect pension expense and our projected benefit obligation, okay? The prior service cost, that's why I waited to explain this, is if the actuaries come back at some point in time and say, well, we estimated the service cost was this for this period, but based on some factors that we were unaware of at the time or that have changed, we think that that service cost for that period should have been higher or should have been lower. We're going to make the adjustment into the prior service cost OCI, which will not affect pension expense when we go to start working on our worksheet here. Okay. Next down, we have interest cost. Okay. This is that implicit interest that if a company was to just give this retirement money to their employees and they can invest it, what the companies could expect to get, or the expected rate of return for the employees. Okay. That is going to be noted in your homework questions as either the implicit rate or the discount rate of some sort. Okay. And to calculate it, it is always your beginning balance of your projected benefit obligation multiplied by your discount rate. That is going to increase your pension expense. It is also going to increase your pension benefit obligation or projected benefit obligation. Okay. Our next one down the line, we have an expected return. So under your plan assets, a company is going to have all those assets, and they're not just going to be sitting around doing nothing. They're going to be invested in bonds or stocks or whatever, and the company is going to have an expected rate of return. And your problems, that is going to be given to you. So to find your expected return, it is always your plan assets multiplied by your expected return. And what that is going to do is you're going to see when we start working on a problem, the expected return is going to lower your pension expense, and it is going to raise your plan assets. Okay? So it's going to lower the amount of expense you have for the period, but it's going to raise the amount of assets you have in your plan. The next one down is our actual return, because it's interesting that we're basing it here off an expected return, but how often do you actually hit that mark, right? So here we're going to make an adjustment for the actual return. So we're going to take our plan assets multiplied by the percent that we actually got, and then the difference. Even though it says actual return here, we are going to be looking for a difference, okay? The difference between what we actually got and what we expected to get is going to go into this gain or loss, OCI. Instead of affecting the pension expense, the actual return is going to be held in this OCI, as you remember, is just kind of a holding category. It is income that is not yet realized, and we don't want to classify it as income, so we're putting it onto our balance sheet. So the actual return is going to go here as either a gain or a loss, and then it is either going to increase or decrease the plan assets. And remember, even though I have it labeled as actual return, it is the difference between the actual return and the estimated return. And as we start working through a problem, you're going to see. Next, we have amortization of the prior service cost. So if you have a beginning balance in your PSC OCI, we are going to amortize it off out of that OCI account and put it into pension expense a little bit at a time. That amount, the good thing is you never have to calculate it. It is always going to be given to you. It is going to increase your pension expense and then lower your OCI. We're going to do the same thing with the gains and losses OCI. Okay, it is going to affect our pension expense. If we had a gain over here, it is going to lower our pension expense. If it was a loss, it's going to increase it, and then we'll amortize it out of there. Here, it is an adjustment, and I should write on there also, it could be a gain or a loss, but this is when the actuary comes back and instead of saying, I need to change a service cost for a year, they want to make a total adjustment to the projected benefit obligation. Okay, they're just saying your whole benefits just need to change. Okay, we would just do that with a one-time adjustment. It would be in gain loss and affect the PBO. After that, we have the contributions. So each period, the company is going to put some cash into the retirement fund to increase some plan assets so they can invest it because they know they're going to have to pay it later. The contribution will decrease cash and increase the plan assets. And our final thing on here is the payouts. These are benefits that have been paid out. We're not going to worry about anything over here. When we pay out benefits, we decrease our obligation, and we also decrease our plan assets. Okay, so that's kind of a breakdown on how this worksheet works. When we get done with this, we will get some totals, and we'll be able to figure out our journal entries. Okay, the journal entries are all going to come from inside this little box here, this worksheet, okay? Some of them you're going to put the total as the entry, some of them it's going to be individual numbers through here. But as we work through a problem, I hope this is going to make more sense because it's not a real hard process. It's just kind of a lot to remember. And since you get to do it at home with your notes in front of you now, it should be pretty simple to work through. Okay, so on our example from our worksheet, we have pension data for Berry Financial Services, which includes the following. And we have a lot of information. First thing we need to do is go through and put some beginning balances in, okay? We are never ever going to have a beginning balance for pension expense or for cash. But let's look at PSC prior service cost. We have a beginning balance of $325. For gains and losses, we have a beginning balance. Okay, I should mention the prior service cost. If I do not put parentheses around it, that is going to mean it is a debit entry. Okay? It's going to come into play as we're thinking of along the line. So when we get to the next one, we have a net gain in OCI. Okay? So a gain means it is going to be a credit. It is revenues, gains are credits. Losses, expenses are debits. This was a prior service cost. It is an expense, so that's why it was a debit. We're going to make this a $330 credit beginning balance, okay, because it is a gain. Our projected benefit obligation is a liability. Liabilities have normal credit balances, so we are going to make it a credit of $2,300, and plan assets have a normal debit balance. Assets normal debit. It is $2,400. Our difference means we have a 100 debit balance in this category, and since it is a debit, it is a pension asset. So actually, this is good. Their pension benefit obligation is actually overfunded at the moment. That is a good thing. Very rare, but it is a good thing. Okay, so let's start working through our worksheet here. I'm just going to go down my list, and then I can go back up and pull off the information that is needed. So the first thing I have is service cost. So I look through, oh, it tells me right away, service cost for 2021 was $310. So that is going to increase my pension expense by $310. Increasing expenses is a debit. And I should mention too, when we're doing this worksheet, every time we put something across these lines, we are always going to balance like a journal entry. Okay? We're not going to make these exact journal entries, but we're going to balance like one. And since that is a cost that the employees have earned that we are going to have to pay them later, we are going to increase the PBO by $310. So to increase it, we need to make a credit to it. Next, we have interest. If you remember, interest is our discounted rate times the beginning, multiplied by the beginning balance in our PBO. So our interest cost in this amount is $161. Our discount rate was 7% times 2,300, the beginning balance in our PBO. Okay, it is a cost, it is an expense, so we will debit that. It also increases our benefit obligation because we will have to pay that out. Next, we have our expected return. So if we look here, our expected return on plan assets is 10%. So our expected return is going to lower the pension expense. So we will make it a credit entry. It was 240, which is 2,400 times the 10%. The expected rate of return multiplied by the plan assets, and that will increase our plan assets by that amount. So to increase an asset, it is a debit, and we stay balanced across there. Next, our actual rate of return. So the actual return on the plan assets was 9%. Okay, so they did not make the whole 10%. When you multiply 2,400 by 9% and then take the difference, it works out to $24. Okay, so they made their actual return was $24 less than what they expected to receive. So remember what that is, a gain or a loss in the OCI. Okay. Since it is a loss, we are going to make it a debit entry. Okay. And we also need to lower our plan assets by that amount because we raised it by what we expected to get. Well, when we actually see what we got, we need to take it off. We will do a credit of 24 to our plan assets. Okay. Moving on down, we have amortization of PSC. Like I said, the good things about these are always going to be given to you. It tells us up here that the amortization amount was 25. So we are going to chip 25 away. It was a debit, so to take it away, we need to credit it to make it go lower. It is also going to increase our pension expense with a debit of 25 over there. To amortize the gain or loss, it gives us the amount of 6, but it was a gain. So we are going to do a debit entry to take that credit down, which means we have a credit over here, which is actually going to lower our pension expense for the year because it was a gain. So it makes sense that it is now lowering the expense shortly over time. The adjustment line, there is not one in this problem. Okay. If there was, the number would go here as a debit and here as a credit. Moving on, it says contributions. Okay, this is how much cash the company gave. So the company gave 245 in cash. So it lowered their cash as credit, and it is going to increase the plan assets by 245. And finally, we get to the payouts, or they will be known as benefits. The benefits were 270. So that is 270 that we no longer owe, so we can debit it because it is no longer obligation to us. And we will lower our plan assets by 270. You go through and add all these up. That is your total pension expense for the period. Okay, you're going to have some questions where it's just going to ask you for the pension expense. So if you know which one of these to pull out that actually make up the pension expense, you can find it and just pull that out. Okay. All these other ones, I didn't do the math out on these. These totals are good to know moving forward, but actually these journal entries are going to be placed in in strategic spots with, depending on whether they match with the expense or this one just kind of matches with itself over here. So it's going to have its own journal entry, but I'm going to go through them next. What I want you to remember here is the one total that does matter is your total expense here. And then after you find your totals here, the difference becomes your new pension liability or asset. Okay, and that is the number that gets reported on your balance sheet. And you hope that it stays an asset or as close to zero as possible, so there's not a pension liability. Okay, so get it good. Look at this. Maybe make sure you have it written down well. I'm going to erase it here, and then we're going to go to the second part that says prepare the journal entries. But you're going to need this because remember they are all coming off this sheet. Okay. In journal entry A says to record the pension expense. Okay, so we're going to go off our sheet, and remember, expenses are debit, so pension expense 250. So what we need to do now, and we have our total, we have to need to look at each of our lines that the expense affected. Okay, and we are going to correlate them so we can end up balancing out our journal entries here. So the service cost and the interest expense both increase the PBO. So I'm going to do a credit to my PBO for $471. That was the $310 for the service cost and the $161 for the interest cost. From the expected return, which also affected the pension expense, my plan assets increased by 240. So I'm going to add the 240. The other two things that affected this, the pension expense, were the amortization amounts. So we had a debit amortization of our gain and loss for 6, and an amortization of our prior service cost for 25. As you see, we are balanced out at 496 on both sides of this equation. So that is your journal entry for A. For B, B says to record the gains and losses. So when we're looking at our worksheet, we had only one gain or loss in the period. Okay, one thing under there that wasn't an amortization amount, and it was a loss for 24. So we have a loss OCI for 24. And from our sheet, we can see where that went. That reduced our plan assets. So we credit our plan assets. Our C is for the funding. When we funding, we increased our plan assets by paying out cash for the 245. And finally, in the when we pay benefits, we reduce both our PBO and our plan assets by the amount we paid out. So once you get through the worksheet, it's just a matter of pulling these numbers out, remembering just match all the pension expense. If it has something along those lines, put it into that journal entry, and then just match up everything else that doesn't deal with expense and give it its own journal. So there are only 4 questions that you were assigned from chapter 17. They mostly relate to calculating pension expense. So like I said, You may not need to make out this whole chart. This is one of your homework questions. It will be different numbers. Okay, this is the hardest one you got. This is one you're most likely to see again on the test. So I'm going to extend the homework, and I'm going to give you until next Thursday at 11:59 p.m. to get through this, so you're not rushed. Okay, and I will also include that in the email, and you'll see that on Connect. Do not hesitate to reach out to me if you have any questions, guys.